Welcome to Trader TV. I'm Dan Barnes. In March, we saw a lot of focus on the US Treasuries market as the Fed started to make changes to interest rates. However, that also has an impact on emerging markets. Joining me today is Chris Perryman, Corporate Portfolio Manager and Head of Trading at PineBridge Investments. Chris, welcome to the show.
Thanks, Dan.
Can you tell us how have EM govies been responding over the past month to changes from the Fed?
For the hard currency EM rates market, we can gauge this by a few measures. I think the first measure really is to look at spreads. And actually, if you look at that measure, EM's been extremely resilient. Spreads over that month have actually tightened in the IG sector, which would be the most sensitive to rates. And in high yield, we saw actually a little bit of widening. And that's really from idiosyncratic stories rather than necessarily rate risk. On the technical side, ETF flows, which for us is really a short-term measure that tends to wash out, but is relevant for a month measure of period. What we've actually seen is inflows into EM rates. So the technical picture is actually supportive for EM as well. So the only challenge really for EM rates, which people probably have felt is the negative spin that gets put on it, is really total return. So the US rate element of that product in terms of total return. So yeah, really EM has been very resilient.
And then how have these movements changed liquidity and price formation for people actually on the trading desk?
What we've seen is wobbles, is how I describe it. I mean, this is by no means March 2020.
Yeah.
What people have taken a lot of comfort from is this is a temporary move. This isn't rates expected to go to the moon and there's no real parameters around it. It's how high do we go for a temporary blip in higher inflation expectations and an adjustment to US growth. So from a pricing perspective, what we've had to focus on is convexity and duration. Mm-hmm. What we haven't focused on is the noise and the interim vol, because EM spreads have been very stable during this period, which makes the pricing easier because really you're trying to manage one element.
And then in terms of electronic trading versus voice trading, how have you seen activity levels change?
From our side, we've changed very little. I think what we've had to do is tweak a little bit where, as I say, those wobbles that I described, we typically trade maybe a small block of risk on an electronic platform. We've moved that to voice just to control where we want the price to go. But overall, liquidity hasn't really been a challenge. It's just been something we've had to work a little bit with. These are tweaks, as I say, again, if we refer back to sort of March last year, that was a different level of liquidity challenge.
What approaches have your traders been taking in order to get best execution on behalf of your investors?
What we've asked the traders to focus on is what's driving the market, which is fundamentals. So, talking to the analysts on a daily basis to update their views on the names that we have very high conviction on. So then they can really focus in on curve anomalies that are created perhaps by the wobbles that we've seen in treasury markets. What's really driven the market in terms of our value opportunities has been the idiosyncratic stories. So for us, we've really looked to add value and give trade ideas around those actually more than the rate story.
How is your role as a price taker changing?
What we've had to evolve is understanding where we want to buy risk and our degree of confidence. The trade desk connectivity to analysts. On the corporate side, we have 13 analysts. On the sovereign side, we have 4 analysts. We need that depth of understanding of the market it's not that we're market making, but it's to understand where we want to take risk and at what price. Because what we've found now increasingly is the street don't have the depth of book to be that risk-taking model anymore. So what they really are is a risk transfer agent, and it's really for us to decide what price do we want to take that risk at.
And presumably that makes a significant difference to your ability to deliver returns to investors.
Yeah, if you look at where the asset mix is and who holds the assets, if you look at how our market's evolved, it's local owners and large institutional asset managers that own EM. This is a very stable asset base. They look at long-term holdings with long-term return objectives. So the shorter-term noise gets washed out in a much smaller period of time. So what we see is, now those momentum trades where there's a headline of outflows maybe last 2 or 3 days. They don't last months as they historically have. That's a much greater opportunity set for us to take long-term views with strong fundamentals driving it.
That's been fantastic. Thanks very much, Chris.
Thank you, Dan.
I'd like to thank Chris for his insights today, and of course you for watching. To catch up on our other episodes, go to tradertv.net.